Every year, the average freelancer hands the IRS $3,000 to $5,000 they didn't owe, not through fraud, just by missing deductions they were entitled to. I'm going to show you all 19, run them against 80,000 of example profit, and by the end of this video, you'll watch that taxable bar collapse by more than half. And deduction number 19, the one almost everyone takes in the wrong order, quietly resizes several of the others. So which one is it, and why does its order matter so much? Quick ground rule before we start. These are illustrative example numbers, not a calculation of your taxes. I'm going to run an example bar down the side of the screen, starting from 80,000 of net 1,099 profit, a hypothetical. Every deduction you're allowed to take shrinks that bar and the income tax you pay on it. By number 19, we'll add up exactly how much came off. Your actual savings depend on your filing status, total income, and which deductions apply. So confirm everything with a CPA or enrolled agent before you claim it. Skip these, and on this example, you'd hand over around $11,000 in income tax you never owed. And by the end, you'll see exactly how that bill disappears. Start with the deductions that move the bar the most. These aren't loopholes. They're the backbone of how self-employment is taxed. Number 1, half of your self-employment tax. As a freelancer, you pay both sides of Social Security and Medicare. That's 15.3%. But here's the part people miss. That 15.3% doesn't apply to your full profit. You first multiply net profit by 92.35%. On 80,000, that's 73,880. Apply 15.3% to that, and your self-employment tax is about $11,300. The IRS then lets you deduct half of that, about $5,650, right off your income. One honest caveat right here. This half SE tax deduction lowers your income tax. It does not reduce the self-employment tax itself. Same goes for QBI, retirement, and the standard deduction in a minute. Keep that straight and you won't overpromise yourself savings. Number 2, the home office. If you use part of your home regularly and exclusively for work, the simplified method gives you $5 a square foot, up to 300 square feet. That's $1,500, no receipts required. Just remember, the home office deduction can't create a business loss. It's capped at your business income. Number 3, self-employed health insurance. Premiums you pay for yourself and your family come straight off your income, not as an itemized deduction, but above the line. Call it $6,000 for a solo plan. 2 limits to know. It can't exceed your business's net profit, and you can't take it for any month you were eligible for a subsidized employer plan, yours or a spouse's. Number 4, retirement contributions. A solo 401k lets you defer your own salary up to $24,520.26, plus an employer contribution from the business of about 20% of your net self-employment earnings, with the total capped at $72,000. We'll keep this example conservative, say $10,000 this year, and every dollar in lowers your income tax now. Number 5, rounds out the heavy hitters, and we'll come back to it. QBI. We're going to compute it last on purpose because of how it interacts with everything else. Hold that thought. 4 deductions in, and the bar has already dropped from 80,000 to about 56,850. We've barely started. Next group, the everyday costs of running your business. Each one is small on its own, but they stack, and most freelancers forget at least half of them. 6, software and subscriptions. Your editing apps, your design tools, your accounting software, cloud storage. 7, business use of your phone and internet, the percentage you actually use for work. 8, a portion of your rent or utilities tied to that home office if you use the actual expense method instead of the simplified one. 9, mileage. The 2026 IRS standard rate is 72.5 cents a business mile. Drive 5,000 business miles, and that's $3,625, but only if you logged it. 10, business meals with a client or collaborator, generally 50% deductible. 11, professional development, the course, the certification, the conference ticket that keeps your skills current. 12, business insurance, and any professional licenses. 13. Bank and merchant fees. Every Stripe, PayPal, or processing fee is a deduction. 14. Contractor and freelancer payments. If you pay an editor or a VA, that's your deductible expense. Just remember to issue them a 1099 if you pay them $600 or more. Add this group up. Call it another $8,100 across software, mileage, fees, and the rest. And the example bar slides again. Now the overlooked ones, the deductions that are completely legal, often automatic, and somehow still left on the table. 15. Startup costs. The money you spent getting the business off the ground, the LLC filing, the logo, the first software, up to $5,000 can be deducted in the year the business begins operating, with the rest amortized. Quick flag. That $5,000 figure is the long-standing Section 195 amount. Double check the final 2026 IRS instructions, since you'll see bigger numbers floating around online that didn't become law. 16. Depreciation on big equipment. That laptop, that camera, that desk, instead of one small deduction, Section 179 often lets you write off the full cost the year you buy it. Like the home office, Section 179 can't create a business loss. It's limited to business income, and any excess carries forward. 17. The half of self-employment tax we mentioned. Yes, it counts here too as the adjustment that lowers your income tax, which is why we led with it. 18. A health savings account. If you're on a high deductible health plan, a 2026 HSA contribution up to $4,400 self-only is deductible going in, grows tax-free, and comes out tax-free for medical costs. It's the rare triple tax-free account. And 19, the one that surprises people and the reason we saved QBI for last. The QBI deduction is 20% of your qualified business income and is calculated after these other deductions shrink your profit. So in our example, by the time we get here, the base is about $36,850, and 20% of that is roughly $7,370. If we'd taken QBI first against the full $80,000, we'd have wildly overstated it. Every write-off you add doesn't just lower your income. It also resizes that 20% QBI break. The deductions compound. That's the part nobody tells you. Here's what that looks like end to end. And remember, these are simplified illustration numbers, not a real tax computation. We started at $80,000 of example net profit. After 19 deductions, the example bar is at roughly $29,480. That's about $50,500 of income the income tax never touches. Now the honest part, nobody pays tax on $50,000 of savings. You pay tax on what's left. At a combined income tax rate around 22%, shaving about $50,500 off your income is worth somewhere near $11,000 in income tax you keep. And to be crystal clear, that's income tax. Most of these deductions don't reduce the 15.3% self-employment tax at all. Even if half of these don't apply to your situation, the missed $3,000 to $5,000 we opened with isn't hype. It's just arithmetic. Your numbers will differ. 2 caveats worth saying out loud. 1, deductions only count if you can document them. A deduction you can't prove in an audit isn't a deduction, it's a risk. 2, this is not financial advice. The on-screen math is a simplified model. It doesn't fully reflect QBI ordering rules, your standard deduction or filing status. Confirm everything with the CPA or enrolled agent before you claim it. So, the short version. Lead with the heavy hitters, have your SE tax on 92.35% of profit, home office, health premiums, retirement, stack the cost of business write-offs, software, mileage at 72.5 cents, fees, contractor pay. Don't skip the quiet ones. Startup costs, Section 179, the HSA. And remember number 19, take QBI last at 20% because your deductions compound. Track everything as you go, not in April. If running an example bar down like this was useful, subscribe. The channel is all money math for people who work for themselves, no fluff. Next up, how much to actually set aside from every invoice so quarterly taxes never catch you off guard. That one pairs perfectly with this. See you there.